Welcome to the Deep Dive, the show engineered to cut through the noise. We take recent market commentary, research, our own notes, and really try to pull out the most important nuggets for you. Today, we're diving into the stock market's current state, specifically how you, as an active investor, can navigate this really crucial earnings season, our mission, to distill what's actually happening and give you a clearer roadmap. So think of this as your shortcut, to getting up to speed on the market's rhythm right now. We'll unpack what more green on the screens actually means for your portfolio. We're pulling insights from sources like a recent Stock Market Today segment, trying to give you that clear, actionable picture.
Yeah, and it's definitely timely. Understanding the nuances of this market groove, as they called it, it's essential. We're right in the middle of what looks like a pretty significant earnings period. How you handle your portfolio now could really matter. There's just so much information flying around, right? Figuring out the signal from the noise is, well, it's key.
Absolutely. So let's jump right into that market snapshot from just this past Friday, July 25th. The feeling was definitely positive. More green on the screens, as our source put it, to end the week. We saw the NASDAQ climb, about a 0.25%? S&P 500 up 0.4.
Mm-hmm.
The Dow gains a solid 0.5%, and even the Russell 2000, the small caps, up 0.3. But here's the big thing. Both the NASDAQ and the S&P 500 hitting more record highs.
Right, more records.
So when you see this consistent, almost calm upward trend, this steady eddy uptrend, what's that really telling us about the market's health? Is it resilient?
Well, what's really interesting here isn't just the strength, the raw numbers. It's how it got here.
Yeah.
It feels like the market has really settled into a kind of groove after that really powerful initial run-up. Remember those wild days earlier in the year?
Yeah.
Huge swings.
Big percentage moves.
Exactly. We're not really seeing those dramatic daily moves anymore. Now it's mostly sub 1% days, as they say, smaller shifts. But that steadiness, that controlled climb, that's actually a very positive, very healthy sign. It means the market probably isn't getting too expended from its moving averages.
Like that marathon runner analogy you mentioned before we started recording.
Yeah, exactly like that. Not sprinting and risking burnout, but a strong, sustainable pace. It creates a really stable, a nice picture, as the source said. And, just as a side point, the NASDAQ blew past 20,000 and now 21,000 pretty quickly. That shows some real underlying momentum.
That marathon runner point really sticks. Consistent, smaller gains may be showing more health than those wild bursts. And to really get where we are now, it helps you, the listener, to remember how this rally even started. It was so different then. Our source pointed out that extreme volatility, like that unbelievable 12% day back on April 9th. Crazy.
That's wild, yeah.
And then that big 4% day on May 12th. Critically, that's when the market gapped up above the 200-day moving average line.
A key technical moment.
Right. So thinking about that history, what are these moving averages telling us now? And maybe more importantly, why should active investors really be watching these lines so closely?
That's really the core of it. Those early volatile days, they were about breaking out, establishing that initial thrust. But the transition since then is what's remarkable. We went from those huge 1%, 2% days to these consistent, smaller gains. That signals sustainable strength. Now, if you look at the technicals, especially the moving averages, they paint a pretty clear picture. The market's been trending above the 21-day moving average line for, roughly 60 days now.
Wow, that's quite a stretch.
It is, yeah. It's on the long end for staying above it like that,
Yeah.
which is impressive in itself. But maybe even more critical right now for the short-term picture is that the 10-day moving average line is actively holding this market.
Holding it, meaning buyers are stepping in quickly.
Exactly. It's not just sort of drifting near it. On any minor dip, buyers are coming in right around that 10-day line, preventing bigger drops. That's a very strong signal of immediate, consistent demand. It really reinforces that the momentum is still pointing up. So yeah, the weekly charts show a lot of up weeks, which means prolonged strength. But crucially, the market isn't getting too stretched. It's not going parabolic, which often leads to those sharp, nasty pullbacks. It's climbing steadily. And that often means there's still room to run without needing a major correction first.
Okay, let's really unpack this for you, the active investor listening right now. We've got these strong, consistent market conditions, this resilient uptrend, but we're also, as the source said, knee-deep in earnings season, reports coming out constantly. So what does this environment mean for your strategy? The source mentioned insights, maybe from someone like Dan Fitzpatrick, suggesting holding on to more of your positions.
Yeah.
Why is that the move right now?
Because usually active investors are looking for the next trade. Right. And this is where, the theory meets the road for active investors. The strategic advice here really does lean towards holding on to more of your positions rather than constantly changing lanes, as they put it, chasing every little move.
Okay, why though?
The main reason is pretty practical, actually. If you sell a winner now, or maybe you get stopped out of a position, it can just be a little bit harder to find good new swing trade setups that fit your criteria.
Swing trades meaning shorter-term holds, few days, few weeks.
Exactly. And finding those setups gets way harder during earnings season. You might see a chart that looks great, technically speaking, a perfect setup.
Yeah.
But then you check and, the company reports earnings in 2 days.
Ah, the freight train.
Exactly. Do you really want to jump ahead of that freight train?
Right.
You're basically gambling on the earnings reaction, which is notoriously unpredictable.
Even for good companies.
Especially even for good companies. So right now, particularly if you got in early on this rally and have some nice gains, it's really a time for letting your early work do the heavy lifting for you. Trust those good entries you already made. Let them ride the trend instead of constantly trying to find the next thing, which is just riskier with all these earnings reports flying around.
That makes a lot of sense, avoiding the earnings gamble. So let's boil it down. What's the action point here? It sounds like, maybe counterintuitively, if you lock in profits here, take money off the table, you're actually lowering your exposure just when the underlying conditions look really good. Is that the main takeaway?
Yes, that's precisely it. I mean, normally taking profits is fine, often smart. But whenever you're this early in earnings season, it creates this unique challenge. It really is tougher to find those setups. Because it's not just the earnings of the company you're looking at. You've also got the earnings of competitors throwing curveballs.
Right. The whole sector can move based on one report.
Exactly. Imagine you sell, say, a strong chip stock. Then its biggest competitor reports amazing earnings 2 days later. The whole sector rips higher, including the stock you just sold.
Ouch. Missed gains and a higher price if you want back in.
Precisely. You've missed out, and now re-entry is way harder, maybe impossible at a good price. That ripple effect from competitors makes finding new high-conviction trades really tough when you've just cut your exposure. So yeah, in this specific environment, strong trend, but early earnings locking in profits too soon could mean leaving money on the table and then struggling to redeploy it effectively. It's about that opportunity cost.
Okay, that really clarifies the strategy right now. Strong market, early earnings, holding good positions seems like the prudent play, patience and conviction. But looking ahead, markets always change. Will we see chances to, shift around or find those fresh setups later on? When can investors start looking for new entries again?
Oh, absolutely. The market's never static, right? While this early part of earnings season is tricky for new trades, that definitely changes. As earnings season continues, as more companies report and we get past this initial flood, there will likely be some of those opportunities to maybe do some of that shifting around. Think of it like a fog lifting. Once the earnings reports are behind us for certain stocks or sectors, things become much clearer.
Visibility improves.
Right. And that's when new, fresh setups can start to pop up. Investors digest the news, new leaders might emerge, clearer trends form after the earnings reactions settle down. So the main takeaway for you, the listener, is really that this current phase of the market rewards patience. It rewards maintaining exposure to the strength, simply because of that underlying consistency and the temporary, specific challenges that early earnings reports pose for finding those clear, low-risk new entries. It's about knowing the terrain right now.
This has been really clarifying. We've covered the market's steady eddy strength, the importance of those moving averages showing health, and crucially, that strategic need for active investors right now. Hold those winners, have conviction, especially through this initial earnings rush. It's a bit of a dance, isn't it? Patience and management.
It really is. And, if we connect this to the bigger picture, in a market showing this kind of consistent strength, but also these unique earnings season hurdles, how do you, the investor, keep cultivating that balance, that patience combined with sharp discernment in your decisions? It's not just about what you buy, like you said, but when you hold, and really understanding the market's current rhythm.
That's a great question to think about, especially as you navigate your own portfolio choices. Thank you for joining us on this deep dive into today's market conditions. We really hope this has given you some valuable, actionable insights. Keep exploring, keep learning, and definitely stay well informed. We'll catch you on the next one.